Okay, in this video, I'm going to talk about a couple of optional long-term care insurance features. The first two I'm going to talk about are optional, but the insurance company is required to offer them. The first one is inflation protection, and that can be sort of done through a couple different means. One is sort of the outright inflation protection, where the benefit amount is basically going to be adjusted for inflation. The other way that that could be done is sort of a form of inflation protection would be a guaranteed purchase option, which basically indicates that there is an option for the policyholder to purchase additional coverage if they wish. And so it's guaranteed that they can buy more coverage. So one of those has to be offered to the person purchasing the policy. Also, a non-forfeiture benefit has to be made available. And for the non-forfeiture benefit, basically what's happening here is kind of the guarantee that a person will receive some degree of benefit from the policy, even if it is canceled or the person dies before invoking it, something like that. Basically, the idea is that there is some degree of benefit that will be received from that, so they can essentially receive the value of that. Another option that may be available would be a waiver of premium, and this is I've mentioned in prior videos. But basically, the idea behind a waiver of premium option would be if this option exists and a person is, say, committed to a nursing home or something like that, and is receiving long-term care, then they would no longer have to make payments or premium payments on the policy. That would typically make the policy probably more expensive, but it kind of makes sense to do that because they wouldn't necessarily have, if the person wouldn't have financial resources to make the payments, then that would be that'd be kind of a helpful feature. And then there's a refund of premium option, and this is basically indicating that if a policy is canceled, then they net out basically the premiums and the claims, and if in excess remains, then basically that can be potentially refunded. A restoration of benefits option. So for if this is selected, then basically what this means is sort of the maximum amount of benefits that'll be paid out is actually sort of restored after an event. So if we have a situation where a person, let's say you're in a debilitating car accident, committed to a skilled nursing facility for 3 months, and they're paying out, then after a certain period of time, if the person has been out of the long-term care for a certain length of time, has been receiving no long-term care, then basically what can happen is that maximum amount that will be paid out is restored back to the original amount, and it is essentially a reset. So that's the restoration of benefits. Bed reservation. So if a person is in a, say, some kind of a, like a nursing home or something like that, but winds up having to go to the hospital for some sort of procedure and is hospitalized for a week or two, the nursing home could possibly give up the bed and that the person had previously been occupying, and which would mean that when the person leaves the hospital, they might have to go to an entirely different facility. So if the bed reservation option is in place in the policy, then basically the policy will pay sort of a holding fee to the nursing home to try to basically retain the bed, to kind of hold the bed open, so that when the person gets out of the hospital and they go back to that nursing facility, they can go back to the same one that they were previously in. Also, respite care. This would is an option that would cover for some of the expenses of a person receiving some long-term care in order to provide a respite for, say, a family member. So it kind of would provide a break, basically, for a family member that had been providing care previously. Also, there can be an option as it relates to shared benefits. So if you have a husband and a wife on a shared policy, so they're kind of they both have long-term care insurance. If the benefits of the first spouse who's receiving long-term care have been exhausted, then they can essentially sort of dip into the benefits associated with the second spouse. So that would be a shared benefits option on a long-term care insurance policy. Okay, hopefully these kind of options make some sense, and hopefully the video has been helpful. Thank you for watching, and have a great day.